Katia. Welcome to week 2 of the Finance Club. Today we're going to be talking about how to use discounted cash flow models to analyze stocks and find their intrinsic value.
I'm Deloney's home, stock and co-president.
Okay, a quick market recap. This week has not been a good week for AI companies and technology companies in general. If you look at the IXIC, it went down nearly 1%. It's a very heavy known influence investing in tech companies. And the chart, most of the market is down 8%. Now we're going to ask you guys a question. Who here, raise your hand if you've invested in a stock before. Okay, and keep your hand raised if you want to say why you chose to invest in that particular stock. Say it.
So if you're making more money in the future.
Well, tell me what stock.
BUG, well, a couple.
What? Well, name one.
Like just mostly just Vanguard stuff.
What? You did 11.
It was mostly just stuff in the Vanguard and some of the
And why did you choose? How did you do any like research when investing in that stock?
Yeah, I just did some internet research and see what's like been going down and what people are saying is going to go up soon.
Okay, so you looked at for a stock.
Stock.
But you read maybe like news articles and you didn't look at the numbers. Anyone else in Jimmy? What did you invest in?
I invested in Tesla.
Tesla? Why? Did you do any research?
Yeah, I did the government kind of report, so to see if it's undervalued or overvalued.
So you did look at the actual values of numbers. Does anyone here know where you can find the information on the company?
You can utilize tidworks.com to see the cash flow.
That's true. That's true.
You didn't know that
And
though.
there, another very famous one is the SEC. Every company has to report to them their earnings, and we're going to be talking a little bit about
Hey, I don't know if whoever knows what SEC stands for.
Securities Exchange Commission.
Generation hands. But now everyone knows.
Okay, let's go.
Yeah. Next slide. So what is discounted cash flow? What is discounted cash flow? It's a way for forecasting future cash flow of the company. And the key idea of this is the discount, right? Because money today is worth more because you can pay back a dividend or reinvest in the company, as opposed to future money which you can't do anything with. And that's what we call the discount. And that's the future slide will talk about the weighted average cost of capital, which is the money it takes for the companies to get that future cash flow or that future money through debt or tax. But the cash flow on the surface level is the amount of future capital for a company and also estimating future cash flow for the other side.
This is the equation, guys, for the So, step 1, first we're going to calculate the cash flow. So, cash flow is the money a company, like the net money a company makes after you like calculated everything. For example, things that add to it are the income of the company, the assets they hold, the investments, usually short-term investments, because they're easier to get money from. Things that lower the cash flow are debt, operation costs, salaries, what the company has to pay its workers. This cash can be used for a lot of different things. It can be used for capital expenditure, increasing and investing in new things to make the company bigger and make more money. Some companies offer dividends, which is paying back a certain amount of money for a stock. They buy back the own stock, which can increase their share. What's your best or, as I said, investing.
So how do you forecast future cash flow? The idea behind this is looking at the previous cash flow from the last couple of years and the current cash flow. Because when you're calculating the discounted cash flow, you don't actually need the cash flow from this year, but you should still always calculate it because it allows you to get a better estimate of what the future cash flow will be. And as Matthias said, capital expenditures or CapEx is very important. It's calculating the cash flow. And for growth companies, you may want to look at their expected innovations. For a lot of companies like Apple, should be priced very highly, you can So companies like Apple may be priced very highly because people expect velocity growth and free cash flow, and this is often why growth companies have a higher.
And these are just looking at how much this increased or decreased in previous years, the percentage can help you graph these three, which will then lead to calculating the overall free cash flow. Okay, now the most important part, and probably the most difficult part, is choosing a discount rate. So this is saying how much is the money in the future discounted if you brought it down to a present time. Because obviously cash in the future is worth less than now. Riskier companies are going to have higher discount rates because you're uncertain how that money is going to be affected. It's going to go down, up, in the future. And this is one of the equations that people use to calculate. So they're going to put this as their R, the discount.
And one thing to note here is that this discount rate applies to the economics of the company, but it doesn't have a lot of correlation with actual stock price because in the short and midterm, the premium or the discount of these stocks is really not determined by the WACC or the DCF, it's more determined by cyclical trends. So this is good for looking at the underlying economics of the company, but you shouldn't trade on.
Just again, we're doing it later. But there's a lot of variables that you put into this to decide. Oh, there's a sign right there.
I'm the
This
saver.
is the finance club. Because there are so many uncertain variables that you decide, you obviously want to tweak this model and not make 100%
So evidence, however, would say one factor that affects future cash flow.
Market value.
Look at these faces you're
Market
making.
value.
Okay, and one M&M to anyone explaining why future money is worth less than present money. Okay, no one wants to.
So I'm gonna play lacrosse with you. Okay. What today, bro? Not
So,
this season.
Okay, so what is WACC? It's the weighted average cost of capital. A company's average cost of financing operations.
I like it.
This indicates the net return a company must earn to satisfy the debt. So there's a lot of variables that go into it, and
Yeah, my life's basically over.
but market value of debt, cost of equity, cost of debt, and corporate tax rate. So cost of equity is the return investors require from buying a company stock. It's another complicated equation, but I decided not to teach about it. Same with the interest rate, or I think it's the interest rate a company pays for loans and fees. The tax. Corporate taxes is usually how much a company pays in taxes, which is usually lower than the actual tax rate because of different ways of getting out of the control tax.
An important note is that this is not subtracted from the profit. So the tax rate for a company is usually excluded. But also, this connects back to last week's senior debt, right? As we talked about with private credit, it's paid out first as opposed to equity, which isn't paid out.
Yeah, exactly. So that's what I was going to say. It's usually lower because lenders are paid first on the returns.
So this is the final terminal value of the company. So when you're calculating discounted cash flow, you have to add variables for each year that you're projecting the cash flow. And that's so important. It's a lot of work to keep doing that, and it's really hard to predict the future of a company 5-10 years. So investors use the terminal value, so they just get the estimate number of a guess that this company's cash flow is going to keep growing at this percentage called G, and that is the terminal value, which just gives them a rough estimate of the future cash flow that should generate a year.
Yeah, it's very tedious to graph all of this into a long period. So terminal value helps. And obviously, a company is usually going to flatline its growth. We grow at a steady amount.
You okay, bro?
Can be a couple
Dude,
different
get out of
things, but
here.
again, it's a variable. You can use inflation, the GDP growth of the company, the specific industry growth, historical growth of the company. So it's a lot of factors, but it's usually a small percentage, like 2 or 3%. Then you're gonna, so you have all of these future cash flows for each year. You're gonna bring them back to the present value by dividing them by the discount rate. And then you're gonna compare it to the current market cap. And if the number is higher, the stock is probably undervalued. And if it's lower than the stock is probably overvalued. This obviously isn't a thing, it's not a perfect thing. But it can give you an idea about the intrinsic value of a company. Since a lot of companies are sometimes now like AI tend to be overvalued because of consumers' attitudes.
And the good note here is that this is fundamentally true, pretty much always, but even in the long term, it won't really have an effect on contracts because economic trends tend to stun individual companies' performance. So this can give you an idea of whether or not you agree with the market valuation, but there's no guarantee that contracts will ever tend to intrinsic value.
It's mainly for people who invest in intrinsic, so value investing rather than looking at other stuff. Usually it's smart to look at other stuff. So again, this isn't a perfect model. There's a lot of things to think about, lots of variables, the forecast period, when we decide to look at the terminal value. Revenue, operating costs, capital expenditure, you're looking at percentages, giving percentages for your future forecast. Discount rate is another thing that can calculate, it still requires variables, same with growth rate for G. If you look at best case, worst case, and in general, just try a lot of different cases of this to really get a good understanding of
And regarding things to think about when investing, obviously branding is very important. Like a company like Apple is valued way beyond its discounted cash flow, and that's because it is like near zero risk of failure, it has international recognition. And that's why it's so important. Because if you trade different discounted cash flow, you want to be very successful. You can value cash flow in a lot more.
Okay. Here are the three equations. Just double checking. Terminal value, discounted cash flow. And does anyone know where this is an evidence how this is put into this equation? This?
I was just wondering, how did the people derive this equation?
How do people drive this equation? Well, there's a lot of math involved, a lot of advanced math.
Do they use some sort of interval?
What?
Do they use intervals?
I think a lot of it is with discounted cash flow, it's difficult to actually connect the company's stock price back to its business economics. So a lot of these equations come from economists, and then sort of hedge funds trying to trade the stock market. So these aren't necessarily equations that traders use, but they use the economics.
But yeah, it's derived from the company's actual earnings.
Should we ask a question? Wait, who can name? Wait, what's one interesting thing you learned?
This guy's so shy. What is going on?
You're gonna have enough for that though.
Yeah. So the discounted rate applies to all companies because it's basically what brings the future money back to the present value. Okay. Anyone else have something interesting?